Damien Foley, and this is a pre-recording on how to read a profit and loss statement. This will be form part of a series around financial literacy on how to read and understand your balance sheet and profit and loss statement. Uh, Again, my name is Damien Foley, and I work for Kinaway, the um, Chamber of Commerce Victoria, or Victorian Aboriginal Chamber of Commerce. So let's begin by first acknowledging the traditional owners. I'd like to acknowledge the traditional owners of the land we meet on here today, the elders past, present and emerging. Just a bit of a disclaimer, the information in this video is general in nature and should not be relied upon. Please speak to your financial, taxation and or legal advisor when making decisions about your business and personal finances. So let's begin. What we will be discussing. Why is it important to be able to read financial statements? The terminology or the words used around financial statements, specifically today, the profit and loss statement. We'll go through several profit and loss statement examples, and as part of that, we'll be using what's called a common size income statements as part of those examples. So why is it important to you and your business to be able to read a balance sheet and profit and loss? So the first reason is around business performance, knowing how your business is performing. Are you making or losing money? Where is your business making or losing money? What do you need to do to correct it to improve your business? That's the first reason. Second, business planning, being able to plan ahead. So now you know how your business has been performing. Where will you focus your attention? What parts of your business should you look to grow or shut down? What options do I have as a business owner to grow my business? Next is capital and finance. So if you're looking to improve your business, what parts of your business will need to be improved with the purchase of assets, research and development, marketing, people, etc. How are you going to fund these improvements and developments to support growth? Are you going to contribute your own money as capital, or are you able to use the existing business assets? Use the existing business assets to receive a loan or finance to secure that loan. Next is exit and succession planning. So when your business or yourself reach a point, you will need to work out how to exit the business by selling it or passing it on to your kids or on to others. In doing so, you will need to know how much your business is actually valued at. So it's very important to understand your financial position and your financial performance to understand what value is in your business for a potential sale or exit of yourself from the business, and what it's worth when you do exit for either sale or passing it on to others. Okay, so let's have a look at some of the terminology that's used. And today we're looking at profit and loss statements, or P&Ls, is what they're sometimes also known as. They're also known as statement of financial performance or income statements. Another part that's important for a profit and loss statement is you'll see a period from and period to. So that's a very significant way to identify that it's a profit and loss statement. A balance sheet, if we look at in later, they'll have a period as at a given point in time. Whereas a profit and loss statement has a period from and a period to that it works with. And it's important to know a profit and loss statement covers from a date to another date. For example, from the 1st of July 2020 to the 30th of June 2021. Or from the 1st of January 2020 to the 31st of March 2020. So it can cover different lengths of periods of a business. So it's not required to only be for 12 months. It could be for only 3 months. It could be for only 1 month. But it's very important to understand that period from and period to when looking at a set of accounts. Next, we've got the sales revenue or sales turnover or annual turnover. So it goes by different names. What this is aggregate or total sales from your ordinary business activities. Many companies, when doing business with you, will want to know what your annual turnover is to gauge how big your business is. People in sales will generally measure on sales turnover, as this is directly related to their performance as salespeople. But be warned, sales turnover is not the most important thing to gauge in financial performance. If sales turnover includes the total sales from ordinary business activities, should you include, for example, JobKeeper as part of your sales turnover? Next is cost of goods sold or cost of sales. So, cost of goods sold are the direct expenses of producing an item you sold. For example, if you make furniture, the cost of the materials is part of cost of goods sold that actually goes into making that piece of furniture. So, that chair or that table. Um, you own a corner store. You sell fruit and vegetables and bread and milk. The cost of these will be in your cost of goods sold. Note that each business will have to determine what is a cost of goods sold as to an expense item. So that's very important. That can impact what we'll look at later, which is your margins. So next, as we're talking, we've got gross profit, which is a dollar value, and we've got gross margin, which is a percentage value. So if we look at gross profit, is sales revenue minus cost of goods sold. The gross margin is the gross profit, so the dollar value, as a percentage of the sales revenue as a dollar value, and that gives you a percentage value. And we'll look at these when we start using common size income statements. We'll see this as part of the examples. Next, we have the expenses. So expenses are typically costs, not part of cost of goods sold. These are items such as accounting fees, motor vehicle expenses, marketing, advertising. There's obviously every different business will have their own set of expenses that are not necessarily part of the cost of actual goods sold or the cost of sales. Next, we have the net profit before tax. This is a dollar value of all income less all expenses except tax. So for many of us, this is your profit that is at the bottom of your profit and loss statement. So your net profit or loss. Normally, in a set of accounts that you will receive from your accountant, they'll be net profit before tax as a dollar value. The next is the net profit after tax, and this is the dollar value of all income less all expenses, including tax that is paid. So we're looking at a tax rate. We'll use 30%. You make $100,000 net profit before tax. If you're using 30% as your tax rate, that net profit after tax will be the $100,000 less the $30,000 tax, which gives you a $70,000 net profit after tax, which is basically what's distributed or available to shareholders, is usually how it's looked at. Next is the net profit margin. So this is a percentage. So we looked at the net profit before tax as a dollar figure. Now we're looking at the net profit margin as a percentage figure. So it's the net profit, typically before tax, as a percentage of sales revenue. Okay, so let's get into the first example. So this first needs a bit of discussion. Example 1, profit and loss statement. Let's look at a simple example of a profit and loss to see what it is telling us. I do encourage you to have your own profit and loss statements on paper in front of you, so you can also look at your own profit and loss to see what your own profit and loss statements are telling you. So the background information for the one we're going to use for the example, in this example 1, is the year is 2021, so the period. Mary owns ABC Company and she lives in Bendigo, Victoria. Her business has only started trading in the last 12 months. So her profit and loss is her first 12 months of running a business. So that's pretty important. Okay, so this is our first example, example one and let's look at the important things that we need to look at here. First of all, this is telling us that this is a profit and loss statement. So we know what type of statement is. It's a profit and loss statement. We know that this is for ABC company proposal. So we know who the profit and loss statement is for, what entity. It's for ABC Company Proprietary Limited. And we also have here the period from, the period to, which is 1st of January 2021 to the 31st of December 2021. So what that's telling us here is the period is for a full 12 months in 2021, but from January through to December. As to say, what we're probably most used to here in Australia is we're used to having a period that is from the 1st of July of one calendar year through to the 30th of June of the next calendar year. So to make things simple for this example, I've just chosen to use a calendar year as my financial year, being from the 1st of January 2021 to the 31st of December 2021, just to make it easy and understandable. Okay, so we know that it's a profit and loss statement for ABC Company for the 12 months from 1st January 2021 to the 31st of December 2021. So what are we seeing first? The first things we're seeing is we've got sales here. And we've got online sales, and we have store sales. So this immediately is telling me that the ABC company sells, and they sell online, and they have a physical store. That's the first thing it is telling us. Next that it's telling us is the online sales generate $22,000 for the financial year, and the physical store made sales of 53,000 for the year, for the 12 months. Okay, that's good. We know what our sales are and where they're coming from, how they're generated. That's pretty good. That's a good way to break them up. Next, we're going to see we've got total sales here. Total sales were $75,000 in total for the year, which is obviously the 22,000 plus the 53,000 here gives us the $75,000 for total sales. So it's just the sum of the online sales and the store sales for the financial year, for the year, to give us the total sales. So that's our sales. Next, we have cost of goods sold. So our cost of goods sold, as we discussed before, cost of goods sold, what are the costs of what we're actually selling, or what goes into the items that we're selling? And so we know that it's a retail by the looks of this. She sells retail, and she sells clothing. She sells jewelry, shoes, and we've also got some postage here. We've got those online sales. She obviously has to pay for postage to get the sales to the purchaser, the buyer. So we know this is an online cost, and these are online plus the shop. They're not broken down. We don't have a breakdown for these. They're just being put all together. That's okay. We'll go with what we have. So what do we know from this? We know that clothing, we had $15,000 worth of sales for the year. We had $7,000 worth of sales for the shoes. We had $3,000 worth of sales for jewelry. We had $1,000 worth of postage costs. And the total cost of all these goods sold was $26,000, because that's a total or a sum of all these costs that give us the $26,000. Okay, let's continue. So now we have the gross profit. Now the gross profit is equals total sales minus cost of goods sold up here. So it's this number, 75,000 less 26,000, $75,000 less $26,000 gives us $49,000 as our gross profit. So total sales minus cost of goods sold. Okay. Let's continue. Now we move on to expenses. You'll see how all these link into each other and they become important for understanding how to read the financial statements, the profit and loss statement. So we've got gross profit of 49,000. Great. So we know where we got to how we arrived at that. Sales, total sales less cost of goods sold gives us our gross profit. Now we move on to expenses. So these are expenses that are costs not directly involved in the cost of the goods sold or the cost of sales that are being sold. So here we've got accounting and bookkeeping. We've got electricity and water utilities, website and software, motor vehicle expenses. We've got actually a breakdown here of the motor vehicle expenses. So of fuel, rego and insurance, the repairs and maintenance, the depreciation. Now, notice we don't have a breakdown of, for example, the electricity and water utilities. So that hasn't been broken down into what's the cost of electricity, what's the cost of water, what's the cost of gas, for example. They've all been lumped into one line as electricity and water utilities, whereas motor vehicle expenses have been broken down. So let's have a little bit of a look at what these motor vehicle expenses are, and we'll be as we progress, we'll understand why having a little bit of a breakdown of these expenses for motor vehicle are, are very good for analysing or looking at what our profit and loss is telling us. So the first thing we know is obviously the fuel. We've got rego and insurance. That's pretty standard. We've got repairs and maintenance, and we've got depreciation. The depreciation is telling me that that ABC company owns the vehicle. And the reason why it's telling me that she owns the vehicle is because because ABC company is claiming the depreciation on the vehicle. And they won't be allowed to usually claim that depreciation unless it was owned in some way, shape, or form. The alternative is if I seen that this was a lease. Now a lease would tell me that that ABC company is renting the vehicle. They don't own it; they're renting it as part of the financial financial arrangements that were entered into. So, and talk to your accountant about the difference between buying or leasing a vehicle and what the advantages or disadvantages are on that. Okay, so we see that that ABC Company Proprietary Limited owns a vehicle. We also see that there's rent. So rent tells us obviously that with the sales from the shop, there's a physical premises. It also tells me that the rent is electricity and water utilities are likely to be associated with the running of those premises, the rental premises. And we've got salaries here. So salary and wages. Okay. So let's have a look at what the amounts tell us. So accounting and bookkeeping, $5,000. We've got electricity and water utilities, $1,000. Website and software, $1,000. Motor vehicle expenses, the fuel, $3,000. Rego insurance, $1,500 or $1,500. Repairs and maintenance, none. This raises a flag for me. Why isn't there repairs and maintenance on the vehicle? Ordinarily, you would expect that at least there would be a 6 monthly service on a vehicle. They might do their own service, or somebody else might do the service on the vehicle for no charge. So if they self do their own service, then they probably won't have repairs and maintenance costs. That might be a possible reasoning. We'll continue. As we said, we move on, and we see depreciation is $5,500. Now, depreciation, I know that depreciation on a motor vehicle is around, it's either this is going back 15 odd years when I worked in tax accounting. The tax rate, depreciation tax rate for a motor vehicle was around the I think it was about 8.5%. So if we were to say 10% was the depreciation rate, just to round it off to make things simple, that would tell me this depreciation, if we're using 10% as the depreciation rate, tax depreciation rate, would have the vehicle would be worth actually $55,000 to get 10% being the 5,500. That's telling me the vehicle is likely a new vehicle, so it's pretty new. That also supports probably why there are no repairs and maintenance, because the vehicle is new. There are no repairs and maintenance, but then you would then ask, well, hang on, if it's even though it's 12 months, it would still need a service. There is also the likelihood that that car is covered by a guarantee by the when it was first purchased. So some dealers will offer as part of their offering on the sale, that they get the servicing for free for 3 years, for example, or for 12 months. So that would explain why there's no repairs and maintenance cost, but there is a high depreciation cost because it's a brand new vehicle. Okay. So next we move on to rent. So rent is $12,000 for the year, which tells me that's about $1,000 per month. It's always nice to know that. Rent is what we won't go into so much. Well, we will. Well, I'll touch briefly on this. Rent is what I would call a fixed cost. It doesn't matter whether you're making money or not, you're going to have a cost of rent. So it's what's deemed a fixed cost. Whereas, fixed cost for rent. Website and software, whether you're making money or not, that will ordinarily be a fixed cost. Motor vehicle expenses, depending on what you're using the vehicle for. If you're obviously using it a lot for the running around of your business, so if you're a tradesperson going to jobs, the more jobs you have, the more you're going to use the vehicle, the more costs you incur. So that would then be, on that basis, the motor vehicle would be a variable cost. The cost would depend upon how often you use it as part of making sales. Or it could be a fixed cost if it's just used for literally driving every day to go and pick up the mail, for example, or to drop off postage parcels every day, because ABC company has the online store. So if that's what she uses the vehicle for dropping off parcels, and she does every day only one delivery at the end of the day, then that would be a very consistent cost. But in saying that, the more parcels she had, ABC company had, she might have to do 2 runs to the for postal deliveries, online sales. per day. So it would actually increase in the costs. So that's why it's a variable cost. Accounting and bookkeeping, I would say accounting is a fixed cost typically. Usually doesn't vary too much year to year. It only varies depending upon it, but it will reach a point where it will stage up. The more work that's involved for the accountant, the more they're going to charge you. So that might come with the bigger your business becomes. So it could be a fixed cost, or it could be a variable cost, depending. Bookkeeping, again, you might be charged by your accountant $1,000 per month to do bookkeeping, or they'll charge you by the hour. So it could be a fixed cost, or it could be a variable cost. It depends how you're charged. Salary and wages. Salaries, I would say they're a fixed cost, but they're also staged. So if you need to put somebody else on, even though because there's too much work for one person, you need to put a second person on, but there might be not a lot of work for that second person. Then when there's too much work for that second person, you put a third person on. So it can be variable. It's an element of fixed cost and an element of variable cost again as well. So we just had a quick look at just what's variable costs and fixed costs. I didn't discuss that as terminology, so I do apologise, but I just wanted to raise it. Okay, so we've got salaries and wages here of $20,000. We're going to assume here that salary and wages of $20,000 is what Mary pays herself through the company to take care of to run the business. So she's only paying herself $20,000. $20,000 is not a lot of money for living expenses, I would think. So that's telling me that there's to look at that. It would also ask me how they supporting themselves off of only $20,000. So it's always a question. So all of these, if we total them up, all these expenses, the total expenses comes to $49,000 for our total as our total expense, $49,000. Okay, so that's our total expenses. We've looked at all our expenses there. So we're looking at what our net profit is, or net loss. And we've actually got zero or nil. So that tells me it's broke even. How can I prove? How do I know this? Well, I have a gross profit of 49,000. I have total expenses of 49,000. So 49,000 minus expenses of 49,000 gives zero, or a break even, or net profit or loss of zero. So she broke even. The ABC company broke even, or made a zero profit or loss for the financial year 2021. So that's what we've been told just by looking at the profit and loss statement for this period. But let's go on. We're now going to go on and have a look at the common size income statement for ABC company for this period for 2021. So we've got this. We're using the exact same dollar figures here. And these are the percentages for this. Now, how do we arrive at these percentages? We have, again, how we derive a common size income statement is we take the line item and divide it by the total sales. So the 29.3% is the $22,000. This here, the $22,000 divided by $75,000, which is our total sales. 22,000 divided by 75,000 gives us 29.3%. For the 70.7% for store sales, that's 53,000 divided by $75,000. So 53,000 divided by the total sales of 75,000, and that gives us 70.7%. So that's how we're coming to the percentage of these. And again, if we just go quickly down, clothing is 15,000 divided by 75,000. That's the 15,000, gives us 20%. And we just go all the way down for each line item and divide the value by the total sales amount of $75,000 here. And that's how we go through and calculate the common size income statement. So how's it useful? Let's have a look. What's it telling us compared to just having the actual sales figures? Why are we using the percentages? I'll put here the dollars and the percentages. Okay, so for now, because it's only 1 year's worth of financials that we have to work with, profit and loss, let's have a look. So we know that 29.3% of the sales came from online. We know 70.7% came from store sales. What's next? Cost of goods sold. Our cost of goods sold were 20% for clothing, 9.3% for shoes, 4% for jewelry, 1.3% for postage. And this gives us a 34.7% total cost of goods sold. So that 34%, which is 26,000, again, divided by 75,000, that 34.7% for total cost of goods sold is derived from the 26,000 divided by 75,000. Okay, these in the right at the moment probably aren't making any sense, but let's continue. They'll start to make more sense as we progress. Okay, so we have gross profit. Our gross profit was 65.3%. Now, for a clothing store, it will obviously from store to store and depending on what they're selling, the size of the store, and the costs involved. 34.7% for total cost of goods sold is probably a little high, I would expect. I would expect it to be anywhere, and again, it will depend on what they're selling and what the offering is. It could be more around the 20% to 33% for the industry average. So 34.7% is on the I feel is a little on the higher side of that 33% that I would be expecting. So your gross profit is only the 65.3% as an outcome of that. Because again, the $49,000 divided by $75,000. And again, I said about 34.7% as against the industry average. This is where common size income statements are very useful because you can compare them. Even though this is a small store, we could compare it to a huge department store on that same basis. It just gives us an idea of how the the business is performing against others, either in the industry or uh, for how the business is performing on an ongoing basis. Okay, so we see that our accounting and bookkeeping is 6.7%, electricity and water utilities 1.3%, website and software 1.3%, motor vehicle expenses, as we see, 4%, 2%, 0 for repairs and maintenance, and 7.3% for depreciation. Again, a very big cost there that we can see. But then we start to see where our bigger costs or expenses come into play. So we can see rent there is 16% of the as an expense of total sales, and we see that even though it's only $20,000 for the salary and wages, it comes in at 26.7%. So it's a big part of the costs of this business. So even though it's only at 20%, so these total expenses come in at 65.3% of the of total sales. So if we go back up here, sorry, I should point out also this 65.3%. That's our gross margin. If we go back to our terminology, that's gross margin, 65.3%. So gross profit as a percentage. So we go down here to our net profit and loss where we've got 0%. This is our net profit margin. As a percentage, which is 0. Okay. So let's continue. That's an example of the common size income statement being applied. So let's stop sharing my screen. And let's go back to what the next part is for the example. That was example 1. So Mary, for the living in Bendigo, started a business, 12 months worth, profit and loss, and that's it. We just done the common size income statement, so we just went through that. Again, we just put the percentages against that. So let's go on to example 2 for the profit and loss statement. Let's look at it's a simple example of a comparison year's profit and loss and common size income statement. So a comparison years means that we're going to have 1 year and then the following year, or we could have for comparatives we might have a quarter, so the March quarter look compared to the June quarter. We could have comparatives of for seasonal purposes. We might not be able to look at quarter by quarter, beside from March quarter to June quarter. We might need to look at the June quarter for 1 year and then look at the June quarter for the next year to be a better comparative because of seasonal reasons. Seasonal reasons could be you're selling ice creams during winter versus summer, selling clothing, so woolen jumpers in winter versus summer. So they'd be the reasons why you would use comparative periods from year to year rather than using comparative quarters from one quarter to the next. So let's have a look at the information we now got for this. We got now in year 2022, Mary owns ABC Company and she lives in Bendigo, Victoria still. Her business has only started trading in January 2021, as we know. So her profit and loss is her second year of running a business. Mary has not made any changes to how she runs her business. That's pretty important. So On this basis, we're looking at year 2021 to year 2022 without any changes that are being made in how she runs the business so much. Okay, so let's have a look at this. Example 2. So again, let's have a look at starting from the very top. Again, it's a profit and loss statement. It's for ABC Company Proprietary Limited. It's from periods 1st of January to 31st of December. And we have here the periods being the year being 2021 and 2022 for those 2 years, from 1st of January to 31st of December. Okay. So what are we now looking at? Let's have a look. First of all, we know that she hasn't made any changes in terms of to the business from year 2021 to year 2022. But what we do notice is, let's have a look at let's first look at the dollar values first of all. So for online sales, she's gone from ABC Company's gone from $22,000 to $35,000. Straight away, we can see she's increased sales in online sales from 2021 to 2022. From 2021, the $53,000 sales for store sales has increased to $62,000. That's good. She's increased her profit, total sales, from $75,000 to $97,000. That's great. But is this how good is this? That's the question. And where is there any change here at all? And where's the money coming from? So let's have a look. This is where we start to use the common size income statement, and we use it for comparative purposes. What we do know is the ABC Company made an increase in profit for online sales, but by how much? They increased from 29.3% to 36.1% of total sales. So the online sales are starting to comparatively as a total a percentage of total sales has increased more as a percentage of total sales. So online sales has increased more than what the store sales have increased comparatively. Store sales have gone from 70.7% down to 63.9%. So that tells us the store sales have come down compared to while there was an increase in profit by the store from 53,000 to 62,000. As part of total sales, it's actually decreased from 70.7% down to 63.9%. So online sales are actually starting to increase more than the store sales as a percentage of total sales. That's important to know. Again, this comes back to business planning, making those decisions. It's important to know where your money is coming from. So let's continue. We've got now cost of goods sold. Again, clothing, shoes, jewelry, and postage. So let's have a look at the dollar value for each of these. What's happened? So for clothing, it's increased from $15,000 in 2021 to $19,700 in 2022. So the costs have increased for clothing for the cost of goods sold. Shoes have gone from $7,000 to $10,100. Jewelry has gone from $3,000 to $5,000 in costs. So we're selling more jewelry, we're selling more shoes, we're selling more clothing. Postage has gone from $1,000 to $1,200. So that's increased also as far as a dollar value. Okay. So that means our total cost of goods sold has gone from $26,000 to $36,000. So an increase of $10,000 in our cost of goods sold. Okay. It's fair enough to say that because our total sales have increased from $75,000 to 97,000. So our total sales have gone from 75,000 to 97,000, and our total cost of goods sold has gone from 26,000 to $36,000. We would expect in this scenario, because we're selling goods, that the cost of the goods sold would also increase with the increase in total sales. That makes perfect sense. But let's have a more closer look at the common size income statement. Let's look at the percentages. So our clothing in 2021 made up 20% of our against total sales. In 2022, it's made up 20.3%. It's a slight increase, but it's still an increase. So this tells us that the clothing has gone up potentially in costs. More so, and on a comparison for the value of our sales. So that's not good. It's 0.3% increase. So let's continue. Let's have a look at shoes. Shoes have gone from 9.3% to 10.4%. Again, there's against total sales, they've increased more as a cost as against total sales from 2021 to 2022 for shoes, from 9.3% to 10.4%. So again, it's costing a bit more than it was last year in comparison. Let's have a look at jewelry. That's gone from 4% to 5.2%. That's pretty significant to go from 4% to 5.2%. So this is not good. This is not a good sign that our cost of goods sold is increasing against our total sales. So we're selling more, but it's costing us more in comparison to in 2022 than it did in 2021. Or we're not charging as much than we did in 2022. That's another possible option. What we see here is postage going from 1.3% to 1.2%. Okay, we've had an increase in the cost of increase in postage by 20% actually. If we look at $1,000 to $1,200, so we're spending more, but as a total cost of goods sold, it's come down as a percentage. So we'll just continue. We'll keep on going to the total cost of goods sold. So our total cost of goods sold has gone from 2021 from 34.7% to 37.1%. So in aggregate, for all our total of cost of goods sold, it has actually increased by, what's that? 2.4% increase. So our costs have gone up for there's several reasons why this has occurred. Either one, our costs have gone up, but we haven't necessarily increased our prices to cover that cost and also receive the same profit that we would expect from as we did in 2021. Or it's costing us the same, but we're charging less as far as the price that we're selling at. And if we notice that the postage has gone up and has come down, this would suggest that, and we also know that online sales have increased. This may suggest to me, this is possibly telling, this is where we start to, this is where the profit and loss statements start to tell us information. So there's some possible options here. One of the first ones I think of is that ABC Company Proprietary Limited has had to compete on online sales, reduce their price, even though they're being charged the same amount for the cost of their clothing, shoes, jewelry. They're being charged the same, or slightly, but they've had to reduce their price or discount their price, and by doing so, they've increased their sales. So that's probably, and the postage has increased, which is telling me they're selling is also selling more postage, as well as the actual online sales have increased. So that's one possible reason why we're seeing these numbers. Why we've got an increase in sales, but our cost of goods sold as a percentage have actually gone up as a cost, and that's. But as an outcome of that, let's have a look. What's been the outcome of that? So the outcome of this is that gross profit has grown from 49,000 to 61,000. So our gross profit, we've actually increased gross profit by $12,000 in those from year 2021 to 2022. That's a positive. Let's have a look at what that means, though, from the perspective of, as a percentage, though, of sales. Gross profit margin, our gross profit margin for 2021 was 65.3%. Our gross profit margin for 2022 was 62.9%. So our gross profit has gone down as a percentage from 2021 to 2022. So we're actually not doing comparatively as well percentage wise, but we're doing better as a dollar value. But that's telling us, and the reason why what all this is telling us is because sales for online have increased. We've made increases in store sales as well. But we can see here that online sales compared to last year have increased. Our store sales from last year, comparatively, haven't kept up to the same as our online sales. So we're selling more online. And because we're selling more online, it is possible that ABC Company has had to discount their prices. In discounting their prices, they have potentially not had the same costs for the what goods they're selling. So the clothing, the shoes, and the jewelry, which means the end result is, while they may have increased their gross profit, relatively speaking, they haven't increased comparatively to the previous year. So they've made more sales, they've made more gross profit, but their gross margin has reduced. So it's something to watch out for. Okay. Let's continue. So we know what a gross profit is. Let's have a look. Let's go on to expenses. So accounting and bookkeeping from actual dollar value is gone from 5,000 to 5,500. So she's increased her online sales, her store sales. I'm guessing that is probably a bit more related to probably the bookkeeping. That's the reason why the costs have gone up. Maybe there's more bookkeeping involved. Maybe there was a slight increase in accounting as well, but probably the increase in all this sales is generating more invoices, which is a higher cost for bookkeeping potentially. But that's gone from 6.7% down to 5.7% as a part of total sales. So that's actually decreased as a component of total sales. So that's a good thing. Electricity and water utilities. They've gone from $1,000 last year and remained at $1,000. But as a cost of total sales, they've gone from 1.3% down to 1%. So all in all, the cost has remained the same. There's been no changes to the business. So relatively speaking, in this circumstance, there's been no change in the costs, but as a percentage of total sales, it's actually come down. So website and software, again, it's gone from $1,000 and still at $1,000 for the year, and gone from 1.3% down to 1% as a percentage of sales. Motor vehicle expenses. Let's have a look. Again, $3,000 for fuel, $3,000 2022 for fuel. So no change in the value, but as a total of sales, it's come down because our total sales has increased, but the cost hasn't. That's why it's come down in as a percentage. Sales have gone up, but the cost has remained unchanged. Therefore, the percentage has come down. Rego and insurance, $1,500 last year, $1,500 this year, and again, it's come slightly down as well as a percentage. Again, repairs and maintenance from last year of 0 to 0 this year. Again, this is now also supporting the assumption that I made from last year that this is potentially, or supports that this is potentially a brand new car that was purchased. So we now look at depreciation. It's gone from 55,000 down to 3,000. So again, this supports again the high value of the $3,000 from last year, that it was a pretty new car, and it's gone from 7.3% down to 3.1%. So that's pretty significant because it's depreciation. So it's coming down as a cost value. Rent, again, is at $12,000 last year to $12,000 this year. So as a fixed cost, remember this is a fixed cost. It's come down as a total from total sales, down from 16% to 12.4%. So the more we sell with a fixed cost, the less it actually is as a percentage of our total sales, because it remains the same irrespective. What's happened with salaries and wages? Salary and wages last year were $20,000. This year they've increased. They've increased to $25,000. So we see that Mary has potentially increased her wage because nothing has changed. So she hasn't put on another staff member. It's only been the increase in sales. She's decided to give herself a increase in her salary or wage from $20,000 to $25,000. Now, what does that mean? It means that because there's been a change in this, it's hard to compare the 26.7% to the 25.8%, because, it's still the same person for doing this, and so she increased her expense, but it's still actually come down as a total cost of total sales, or an expense of total sales. So that's a positive thing there, especially when you consider usually for these types of things, cost of goods sold is usually your highest expense when looking at a retail business, and then your next one is salary and wages. So that's actually pretty good. So what does this all mean? We have a look at total expenses have gone from 49,000 to 52,000. So they've increased by $3,000 as total expenses, and as a result, against total sales as a percentage, they've gone down from 65.3% to 53.6%. Now that is significant. That's really good. That's a incredible amount of change as a percentage. So as a result of that, we have for 2022 our gross profit of 61%, $61,000, less total expenses of 52,000 gives us a net profit of $9,000, and that's 9.3%. Net profit of 9.3% against total sales. 9.3% for retail in the industry, I would expect that to be pretty good. That's good or average or thereabouts. But again, I don't have the data for the industry to be able to compare it to. If I did, I'd be able to say, well, 9.3%. If it was meant to be 12%, I'd say, well, it's under the industry average. If the industry average was 7%, then I'd say, well, they're doing actually rather well because they're doing 9.3%. So this is where the common size income statement is very useful for comparison against of your business against other businesses. And those industry averages can actually come for, depending upon the industry, can actually be broken down also into small, medium, and large businesses for comparatives as well. So talk to your accountant if you wanted to understand how your business is performing against the industry average. Okay, so the ABC company has made a profit of $9,000 and a net profit of $9,000, and their net profit margin is 9.3%. So that's pretty good, I would think. Okay, so now let's move on. Okay, so we've just done example 2 with comparatives from 2021 to 2022 and also using common size income statements. So let's move on to the next one. Oh, too far. So profit and loss statement example 3. Sorry, I'm just preparing for example 3. Example 3, comparison years profit and loss and common size income statement with business changes and improvements. So there's been changes and there's been improvements that have been done in comparison year for this one. The background information that we've been provided is 2023. Mary owns ABC company and she lives in Bendigo still in Victoria. In 2023, Mary has started to close the store 2 hours earlier at 3 p.m. That's interesting. She's made a change of closing the store at 3 p.m. 2 hours earlier. She spends 2 hours per week to record, edit, and upload videos of her making clothes. Mary then sells these videos as online classes. She buys fabric to both sell pre-cut do-it-yourself workshop kits and to make her own handmade clothing lines. Mary works additional hours after 5 p.m. to make the clothes to order from online sales. Okay, so she does her own handmade clothing line and she makes the clothes to order from online sales. So it's not going through the store. She's not making the sales through the store for the clothes that she hand makes. She's making them online sales. And she's posting videos up online and selling those, and also selling pre-cut do-it-yourself workshop kits as part of those videos for other people to make. She's also closing the store 2 hours earlier. So you would expect that if you're closing the store 2 hours earlier, that you're either, one, you're not making none or very little in sales for those 2 hours to be worth being open for those 2 hours, to justify why she would keep the store open until 5 p.m. rather than 3 p.m. If there's no difference in she's not making any sales during that period, then there's no point having the store open. That makes sense. She spends the 2 hours per week to record and edit those videos. So she's only spending 2 hours per week. So she's actually giving herself time. But Mary's also working additional hours after 5 p.m. to make the clothes. So she's spending time while she shuts the store early. She's spending time also instead making clothes for online orders, which is interesting. So let's make the assumption with this that she's potentially using the time that she would ordinarily spend for in the shop making for those 2 hours. She's actually using those 2 hours to make clothes instead. So the cost is probably moved from the store to the online store. So the shop store to the online store, those 2 hours of a time. Okay. So let's have a look. Okay. So example 3. We have, again, we start from the very top. What's this telling us? It's a profit and loss statement. It's for ABC Company Proprietary Limited. It's a period from 1st of January to the 31st of December. And if we have a look, the periods are for 2022 and 2023. They're the years. So we now know that it's a profit and loss statement for ABC Company for the 12 months of 2022 to 2023, from 1st January to 31st of December. Okay, again, let's have a look at what the dollar values are telling us. Online sales have gone from 35,000 to 69,000. So they've increased. Online sales, almost double if we were to look at it. 35,000 to 69,000, almost double. Store sales have gone from 62,000 to 58,000. So they've actually come down. Store sales have decreased. This kind of makes sense because Mary has stopped working in the store for 2 hours at the end of each afternoon. So that's possibly where she's had lost sales of that $3,000. We have material. We don't have material sales last year. We don't have also classes, so the video online sales from last year. The materials would be where we would assume she's selling those DIY kits, is the material sales. And so this year, ABC Company has material sales of $8,000 and classes sales of $8,000. Okay. What does that mean for total sales? Total sales have gone from $97,000 to $143,000 in 12 months. That is pretty fantastic to be able to do that. That's great. She's gone from ABC Company's gone from $97,000 in sales, and in 12 months increased that to $143,000 worth of sales. And we're just looking at the numbers, we can see that makes up almost, our online sales make up half of the total sales. We see that, so 48.3%. Store sales make up only 40.6%. So online sales for year 2023 have overtaken store sales as a percentage of the sales. And then we've got up and coming new forms of sales of materials and classes of 5.6% each as well. So that's excellent. The question now is, taking that all into consideration, the next thing, can we compare year to year for the percentages, the common size income statement? Can we compare online sales from last year as a percentage to online sales in 2023 from this year? Can we do that also compare for store sales from last year, 2022, to store sales of 2023? I'm going to say not very reliably. We can't reliably compare using percentages, and the reason why is this: it's because last year we didn't have material or classes as sales, but this year we do. So this changes the makeup as a percentage of 100% of what our sales are. Last year, we only had online sales and store sales. Whereas this year, we've got online sales, store sales, materials, and classes. It's going to be a little skewed if we try to compare online sales from last year as a percentage to online sales this year as a percentage. So this is where there's a bit of a where the percentages don't always are not always reliable to use, and I would be hesitant to use them in this circumstance for individual line items. And I say individual line items because for online sales, the store sales, materials, and the classes. But what I will look at though is I will look at um, just the total sales, and they've just increased, that's a positive outcome. Okay, and I would look at common size income statement for the year, not as comparatives. Okay, let's move on. So we've looked at total sales. Let's look at the cost of goods sold. So, cost of goods sold in 2023, we've also now got materials as an additional cost of goods sold. We didn't have it last year. So, again, on this basis, cost of goods sold and the percentages for comparison again of year against year for each line item, not necessarily going to be as reliable as we would like. So I would be hesitant. So let's just look at the actual sales only. So the dollar value of the sales for each of these. 2022, the clothing was 19,700. This year was 19,700. Shoes have gone from $10,100 down to $7,000. Okay, she sold less shoes this year. Why? Why have the sale of shoes gone down? That's interesting. Okay, let's have a look at jewelry. Jewelry's gone from $5,000 to $7,000. So there's been an increase in sale of jewelry, or more jewelry's being purchased. So that's also interesting. Okay, I would ask the question why? Why has she sold more jewelry this year than last year, but sold less shoes from last year to this year? Postage has gone from $1,200 up to $1,800 or $1,800. Now that makes sense because, as we can see, online sales from last year have almost doubled, but the cost of postage has actually only gone up by 50%. So from $1,200 to $1,800. So a difference of $600, increase of 50% for postage costs from last year to this year. But our online sales have doubled almost doubled. So this is telling me, so looking at the postage or looking at the online sales, there's a couple of things that this income statement is telling, this profit and loss is telling me. And it's one of several possible reasons that it could be happening. Online sales have increased, given as a dollar value. Postage has increased, so there's more postage being done because of the online sales, but the postage hasn't increased at the same amount to what the online sales have. That's telling me either the cost of postage has come down significantly, perhaps because she's making more postage, doing more postage, that they've reduced the price of postage because there's more volume of postage going out. That might be a reason why the price of postage has come down. Or this might be a bit more of a reason that I would probably lean more towards, is perhaps ABC Company is actually selling more sales per order than they did last year. So, for example, instead of selling something $100 worth of items like they did last year per order on average, they're selling now $150 on average per order. And that would explain why the postage has only gone up by 50% in costs, but online sales have almost doubled. They're selling more, potentially. So they've gone from $100 worth of, they've gone from $100 sale per order last year to $200 per order this year. That would explain the double increase in the online sales, but the postage hasn't gone up as much. So that's a possible reason why that we've got only not the same increase in the cost of postage as the same increase in the online sales. We're selling more per order. That's why, in dollar value. Can we justify any of this as being the reason? Well, let's have a look at what in the cost of goods sold, what has increased and decreased as far as what we've been selling. We can see that our shoe sales went down from $10,000 to $7,000. They're a bit, well, first of all, clothing has remained the same. There's been no increase in the cost of clothing that we purchased from last year to this year. Shoes have gone down as far as for sales for the amount cost. So we probably buying less shoes. We're closing the store earlier, so does that mean we've probably sold more shoes through the store than we do online? Shoes might be a bit bulkier depending upon what type of shoes they are for online sales. Whereas jewelry, we've increased our jewelry significantly from $5,000 last year in cost to $7,000 this year. So we're selling a lot more jewelry. Now, jewelry by its nature is a lot smaller and a lot easier for when it comes to postage to sell. We probably could potentially be getting a good price for jewelry. So that's one of the reasons why we see potentially postage has gone up. We might be selling more jewelry online. That might be the reason why. Also notice that material, we've got $15,000 worth of material. Okay, let's have a look at this material. If we've got $15,000 worth. If we've got $15,000 worth of material, where is that being sold? And we know that the material came in at the same time as the sales of material for the DIY came in and the classes came in. But also, and we need to look at that in the context that materials sales of $8,000 for the DIY kits, but we have material expense or costs of $15,000. I would hope that ABC Company is not, or Mary as ABC Company, is not selling $15,000 worth of material at a sale price worth $8,000. That would be definitely going backwards. I would expect Mary would know exactly what she should be selling at. So why is the material for the cost higher than the material for the sales? The reason is that, don't forget also that she was making online sales of her handmade clothing. So we could potentially see in these online sales the material was being made into clothing, handmade clothing. So she hasn't converted this. The correct way for you would ordinarily do this is would take those costs and actually put them into the cost of clothing. It appears that Mary hasn't done this potentially. And what she's actually done is left the handmade clothes as material, and part of that material is gone into the DIY kits and into her online sales. So she has converted that material into a cost as clothing to then make that as an online sale as part of that. So it wouldn't be easy for us to compare again how this looks for online sales versus the store sales for this year. We'd have to need a better breakdown of what each line item was. Okay, so let's give us a bit of an idea. And again, see, this is where you start to read the profit and loss, and you start to see, oh, this makes more sense. This is starting to tell me something. We're not getting all the answers. But we're starting to see things. If we know a little bit of information and background information, we can start to see how this all affects in the profit and loss statements or financial statements. Okay. So let's have a look at total cost of goods sold. We can look at $36,000 from last year to $50,500 this year. If we just look at these numbers very quickly, we can see that's an increase of $14,000, which is not quite 50%. So total cost of goods sold has gone up by 50%, and our total sales have gone up by about 50%. They're about the same if we were just to look at those numbers on their own right. We have to be careful about how we use these other numbers, the common size income statement, because what this is saying is total cost of sales, total cost of goods sold has come down from 37.1% down to 35.3%. So it's not a good indicator when we've got all these changes that have occurred from year in previous years. So we can only look at these for each in their own individual year. So we're not going to look at the cost of goods sold and the gross profit for 2021. We're not going to look at the cost of goods sold for 2021 for doing some analysis here. We're using the common size income statement. What we'll do is only look at, for now, let's look at just the 2023 using the common size income statement. So we've gone from we've got 35.3% of our total cost of goods sold, and we've got a gross profit of 64.7%. So we've come back up from last year. Gross profit margin. Remember, gross profit margin. That's the gross profit margin. Remembering our terminology. Okay, so gross profit overall has gone up, improved from last year. That's a good thing. So that's excellent. Okay, so our gross profit's gone up. Let's have a look at. Let's now have a look at our expenses. Now we've got accounting and bookkeeping has gone from 5,500 to 6,000. Again, there's been a slight increase. We've got advertising. We didn't have advertising last year, but we have advertising this year. Why have we got advertising this year? $5,000 worth. Okay, we know from already, if we go back slightly up, this advertising might be associated with the online sales. Maybe that's part of the reason why online sales have increased is because with ABC company has spent money on advertising, on marketing. Maybe that has contributed to the increase of online sales, putting more adverts up, being able to, and as a result of that, more clicks get her more sales, online sales. That's a pretty reasonable thing to think. If the marketing or advertising was for her store, I would have questions about that. Why would you be putting advertising in of $5,000 into a store when one you're closing your store earlier each day, and you can easily see that sales have come down from 62,000 to 58,000. You wouldn't put money. It wouldn't make sense that the advertising is going towards the store. It's going towards the online sales, or towards her classes to advertise or promote those. So that's possibly where the advertising has gone as well, potentially. So, or it could be to promote her handmade clothing, which are a part of her online sales. So this is where, again, the financial statements, this profit and loss is telling us information, and it's telling us a story. We just need to know how to read it, and it's not always straightforward, and it doesn't always give us all the information that we're actually wanting, because it doesn't tell us everything. It's just telling us what it has to tell us, and we can only read what is there. We don't have. If I had the accounting software that had access to the accounting software, so they were using Xero or MyOp, I might be able to go in and have a look at the advertising that was spent. We could see where the advertising was spent. It might actually state the invoice was for online sales with Google, or for Facebook, or it might have been with Etsy for her handmade goods. There's all these. If we were to go in and look at that, we could see where the money was actually spent, and would know straight away. So yeah, that's the benefit also of being able to drill down into the different line items for your profit and loss statements and your balance sheets for your different financial statements. Being able to drill down and look at all the transactions together, quickly scanning through and seeing where the expenses were attributed to. Okay. So, getting back to expenses. Electricity and water has increased from $1,000 to $1,200. Does that make sense? Well, Mary's staying back after work from 5:00. After work from 5:00. So, she's probably, and also if she's making clothing, she's potentially doing sewing using a sewing machine. If she's staying back late at night, she's probably using the electricity for lighting. She may also have a special garment machine to press the garments, so they're not all creased, for example. There might be a special machine that she used for wrapping her online sales now as part of that. So that requires electricity, the water for steaming, all these different things that they're all they can all be justified without looking into, again, being able to look into each transaction. That's probably why there's been an increase in the electricity and or water utilities costs, because she's been staying back late at night. We see an increase for the website and software from $1,000 to $1,500. Again, we can justify that. I would expect that the reason why that is because she's doing the online videos, so she's having to use editing software. She's had to buy that or acquire it. Doing recording software potentially. So that's where the additional costs have come in for this. Motor vehicle expenses, again, we see it's very consistent. $3,000 for fuel and rego. For fuel, rego in insurance is still at $1,500. There's been no real changes here. So now she's also going back to what we were discussing before. If her fuel hasn't changed, this tells me that she's not using the car any differently to what she was before. But we know that her online sales have gone up, so postage. So it tells me that either her car is still big enough to take all of the parcels to the post office each day, or she's able to transport the parcels. Either somebody's coming and picking it up, and doing it so it's from door to door delivery and pick up and delivery, which means she doesn't have to use a car to deliver it, or the car is able to fit all the parcels into the back. So it might be a station wagon, for example. She can put all the parcels in the back and take them to the post office in one go. That's possible reasons, because the fuel hasn't gone up in price. And again, where this is based on the assumption there's no change in fuel price as well. Okay, so we're assuming that there's no variation in fuel price going up or down. So there's been no change in the fuel, which means she's not using a car any more than she has in the last previous year or the year before that as well. Remember, it was still at $3,000 for the fuel. So not using the car more or less than previously. Again, repairs and maintenance this year as to last year, there is none. As we can see, we've got depreciation coming down from 3,000 down to 2,000. So yeah, we're getting a decline in the depreciation rate. And it's probably, again, still a 3-year-old car, so covered by warranty for the servicing, and that's why there's no repairs and maintenance involved. Tyres would, potentially, depends on what Ks we're getting on the tyres, but nothing else I could think of would have wear and tear. So, yeah. With that, again, rent is still sitting at $12,000 per year. So there's been no change in the rent from year to year. What's next? The salaries and wages. Salary and wages gone from last year, 25,000 to 50,000. Okay, looking at that straight up, we can see the salary and wages have gone from 25,000 to 50,000. They've doubled from last year in dollar value. This is where we can't use the common size income statement. It's not really good too reflective for these line items as individual, because again, there's it's not comparative because of the sales involved. So okay, she's increased her salary, and again, she's closing the store 2 hours earlier each day. So she wouldn't be hiring an extra person to go into the store, but she's been able to increase her salary by doubling it from 25,000 to 50,000. So that's positive. That's good. Okay, so let's have a look at the total expenses. The total expenses have gone from 52,000 to 82,200. And we will look at the common size income statement for this, just for this, for the total expenses. So they have increased, and they've gone from 53.6% to 57.5%, which is reflected in the expenses. They've increased. So again, we now look at the net profit, and her net profit has gone from $9,000 last year to $10,300 this year. That doesn't look great, and it's reflective if we look at the net profit margin. The net profit margin is saying it's gone from 9.3% last year to 7.2%. That's a pretty big reduction. And if we look at the 53.6% to the 57.5%, it's probably in our expenses. So our expenses seem to have increased. And that's why there's been a reduction in the net profit and loss from 9.3% down to 7.2% of total sales. This doesn't look good on the face of it. But remember this, our total expenses have gone up. Why have they gone up? This is why. Our total expenses have gone up. One of the main reasons is because her wage has increased from $25,000 last year to $50,000 this year. Now, that's money that Mary is paying herself. Now, if Mary, we're again using an assumption, if Mary's the one who owns ABC Company 100% of all the shares, then what she is doing, instead of what's happening is she's paying herself a wage, increased her wage by the $25,000 to pay herself, instead of it sitting there as a profit, because if it was sitting there as a profit, then instead of that 25,000 going to a salary, it would go to the profit or the bottom line, the net profit, and this would actually be sitting at $35,300 as net profit. And that's a lot better than last year, a lot better. So this is why you've got to be careful when looking at these, the percentages for the common size income statement, is because they don't always tell you exactly the truth. They're just a good comparison tool. So you do sometimes need to look at these and take other things into consideration. We need to take into consideration that Mary's paying herself an additional $25,000 this year compared to last year, because if we take that in consideration, then she's actually done very well this year as well compared to last year. So we can't just say that the net profit of 7.2% is not really good because she's paid herself a wage. And she's taken that money out of the company as a wage, instead of either one, leaving in there, which would increase her net profit, and therefore that would profit, she would have to pay tax on that. So instead of paying tax on $10,300, a company tax, she would be paying tax on $35,300 at the company tax rate. But then her salary and wage is being taxed at the marginal tax rate. So this is where we start to talk about tax planning. And she's decided to take it out as a salary, and she will be taxed at her marginal tax rate, that $25,000. So it might actually be less than what the company tax rate is of 27.5%. She might only be taxed, I haven't looked at the marginal tax rate, so it might be 20, 20%, because she's taking it out as a wage rather than paying the company tax rate. So that might be the reason why she's done that, for tax planning purposes. Her accountant has advised her to do so. So yes, but we can't rely purely on this 7.2% of the common size income statement, the net profit margin. It wouldn't tell us the whole story of what's going on with this business to say whether it's performing well or not. So, yes. So that is an explanation of the of our example. For example 3, she's actually done pretty well. The business is going well. She's changing. She's learned from in year 2 that online sales were doing better. She's changed because of that. Made change to her business in her business decisions, and moved towards online sales and reduced her store sales. Okay, so if in this scenario, let's throw up the assumption, if Mary was to come to me and say, "Well, Damien, my online sales are doing better. I should I stop having my store altogether, just based upon these numbers that we have here in front of us for 2023 and 2022?" Looking at it, I would say, well, what are you going to save if you don't have your store sales? It's going to cost you potentially $58,000 worth of sales. What you save in expenses, you might save a bit more in obviously your costs. They're going to come down. But in saying that, your online sales, you're potentially discounting your online sales to be able to make those more sales. You might be getting a better profit from your store sales than you do from your online sales. So that would be a reason why you would actually keep the store. You're making better profit margin from the store potentially. The other thing is, would she cut back on her electricity and water utilities? Possibly, she may. What would be the alternative if she was working from home, doing online? Would she still be using the electricity? Would she still be using water? Would she still be using gas? Yes, she would. She would still be need to using that. So except for maybe if she has a fridge at her store, she wouldn't have a second. She probably wouldn't need a second fridge back at home for doing online sales from home. But I would say, overall, the electricity and water utilities would just be moved from partly to over to home. So there wouldn't be too much of a saving there. What else? Motor vehicle expenses and fuel. Well, if she's only using the car if she's using it to travel into to another location, maybe she lives rurally and travels into Bendigo itself, she'll be cutting back on the travel time, the travel for that, if that's part of the expenses. But in saying that, I would guess that the post office, nearest post office to her, wherever she lives in around Bendigo, would be in Bendigo. So my guess is that she would have to travel into Bendigo anyway. So she would be incurring these costs anyway. So there'd be no savings. Incurring these costs. Incurring these costs anyway. So I don't think that will make too much of a difference. I would say definitely rent. Unless she has to invest into getting at home, she needs extra storage, so she needs to get an extension or something done to her house to fit in materials and all that, or build a shed or something for storage. Then she would potentially save on rent, that $12,000 rent. But it's only $12,000 versus the $58,000 in sales. So at the moment, I would expect, I couldn't find a good enough reason to close the store. I would have to find good enough reasons why it would be better for her to spend more time doing the online sales. Um, if she could justify that she could increase the online sales of her handmade clothing, where she dedicated her time to doing that during business hours rather than spending it in the store, and she could demonstrate that she could make more sales from doing so at better profit margins, a better profit, that might be a reason. But as it stands at the moment, no. I would say that I would suggest in this scenario that she would keep the store open. So this is how you start to look at the profit and loss statement to make valued business decisions. Could she exit or sell the business? She's only been going for 3 years. How good is her online sales? Her online sales are increasing, so that would be a good reason to indicate that she's probably potentially going to do better next year because they have been growing year on year compared to her store sales. She's only invested $5,000 in advertising this year for the first time, and online sales have increased. What happens if she invested $10,000 in advertising? Would her online sales then increase even more? And at what point would it matter that how much she spent in advertising that her online sales wouldn't increase? So maybe that would be a way to find out. She would increase her advertising, see if online sales increase, then consider whether she needs to spend less time working in the store, or does she put somebody else into the store to operate the store part-time, so she can spend more time making clothes because there's better return for that compared to the cost of, she makes more profit from doing that than the cost of putting on an employee to be in the store part-time or casually. That's a possible option that's available. So yes, that's where the benefit of having a profit and loss comes into play. Okay, so let's go back to the screen. So we just had a look at the profit and loss statement for that example 3. So the summary of all this for reading a profit and loss statement is it is important to be able to read financial statements as they tell us a story about our business. As we've just seen by these examples, and these are very basic small businesses. Like, we're not talking big dollars here, and we're not talking about a lot of it's very basic information that we've been given, and we could pick up a lot of information from doing so. We've been able to make more better decisions. In reading a profit and loss statement, you will need to understand the words or terms that are used, such as annual turnover, cost of goods sold, gross margin, net profit margin, etc. There is information you can learn from reading your profit and loss statements that can help you to make better business decisions. And we've been able to do that just in these examples. So imagine if you sat down and you were able to generate a common size income statement of your business for either last financial year or when nearing the end of this financial year. So you would have a good indication for this financial year how your business has been performing if you were to print one out. So common size income statements use the annual turnover to convert the income and expenses into percentages, allowing you to more easily compare with previous years or with other companies in the same industry, even in different countries. Because think about different countries, they're going to have different exchange rates. So they're not going to be Australian dollars versus Australian dollars. You're going to be Australian dollars versus US dollars, or Australian dollars versus the Japanese yen, or the New Zealand dollar. So if you're using percentages, that negates all the issues of different exchange rates. So yes, that's it. I hope you enjoyed doing this webinar. And I do hope that you take the opportunity to look at your own profit and loss statements and using, if you've got accounting software to do so, to print out a common size income statement and to also use the comparative financial statements, such as especially for profit and loss, to have a look at yourself. If you've got any questions about this as a Kinaway member and to better understand how you can look at your financial statements and your profit and loss, by all means, send an email through to info@kinaway.com.au with your question, and we'll try to get back and answer that either directly via the email, or if we get enough responses via email and we're getting the same questions, we might even do another separate video to explain those questions and maybe give some more examples of how that's in use. So thank you.